When you look at global events, I think you expect a certain logic to hold true, right? Like a clear cause and effect.
Sure, yeah. Basic economics.
Exactly. If a severe frost wipes out half the coffee crop in Brazil, the price of your morning espresso goes up. The math is straightforward. But right now, we're looking at this massive contradiction in the global economy that just completely defies that basic logic.
It really does. It's a bit baffling if you only look at the headlines.
Right, because here we are in April 2026, and the Strait of Hormuz, which is arguably one of the most critical energy arteries on the entire planet, is operating at just 8% of its normal capacity due to regional conflict.
Yeah, just 8%, which is wild.
So conventional wisdom says crude oil prices should be going straight to the moon. I mean, we should be seeing absolute panic at the pumps, skyrocketing futures, all of it. But that's not happening. So if you've ever wondered why crude oil prices seem entirely disconnected from what you actually pay at the gas station, today we have the answer.
We do. Because we are witnessing a historic disruption in supply, yet the broader crude market is behaving with this eerie sort of calm.
Yeah.
It really forces us to ask what invisible mechanics are operating under the surface.
And to figure out exactly what those mechanics are, we are doing a deep dive into a brand new April 2026 investment research report from Goldman Sachs. It's titled Softer Oil Demand, More Two-Sided Risks to Unchanged Price Forecast.
Which is quite a mouthful, but a very revealing title.
It is. So our mission today is to unpack the underlying logic of this core conclusion. We're going to explore the key data, like why the price at the pump is telling a totally different story than the price of raw crude, and the core drivers causing consumers and industries to alter their behavior. Plus, we'll get into the major risks threatening the market.
Yeah, and I think understanding Goldman's baseline forecasts is the best place to start. Because despite the severe geopolitical turmoil, choking off the Middle East right now, their analysts are actually maintaining their 2026 average price forecasts unchanged. They have Brent crude sitting at $83 per barrel and WTI at $78 per barrel.
Okay, let me stop you right there, because I'm looking at these numbers and I'm struggling to make the math work here.
I know, it feels like a typo.
Right. Let's look at the physical reality of the Strait. Normally, you have about 20 million barrels of oil per day passing through that choke point. Because of the current blockade, that flow is down to just 1.7 million barrels a day.
Which is a 92% drop.
A 92% drop. If you take a 10-lane superhighway and suddenly barricade 9 of the lanes, you don't just get a little bit of traffic, you get absolute total gridlock. The toll prices for that single open lane should go parabolic. How on earth is Goldman Sachs keeping their price forecast in the $80 range when the physical supply is choked off this severely?
Well, the math does seem broken on the surface. Under normal historical circumstances, losing over 18 million barrels of daily flow would trigger an immediate price explosion. And honestly, earlier this year, that was the primary upside risk dominating the markets.
Traders were bracing for crude to breach, what, like $150 a barrel?
Exactly. But the report notes that the risks to their forecast have shifted dramatically from significant net upside to two-sided.
Two-sided. So the gravitational pull pushing prices down is suddenly just as strong as the supply shock pushing them up.
Yes. That expected price explosion is being counterweighted by two massive forces. First, the geopolitical angle. We're seeing faster than expected peace deal negotiations in the region, which normalizes the market's risk premium. Traders just aren't pricing in a multi-year doomsday scenario anymore.
Okay, that makes sense on the speculative side, but what about the physical side?
That's the second factor, and really the core driver of this whole report. We're witnessing a surprisingly aggressive drop in global oil demand. Going back to your highway analogy, the road is indeed choked down to one lane, but the number of cars trying to drive on it has plummeted.
Okay, but if supply is squeezed that tightly and prices are flat, demand has to be cratering. But why? I mean, why is demand plummeting if crude prices are relatively contained? The Goldman report says crude is around $99 a barrel in real terms.
Right, which is elevated, but well below the real price peaks we saw during the 2011 Libya war or the 2022 Russia-Ukraine war.
Exactly. A $99 barrel of crude shouldn't be high enough to destroy global demand this aggressively, should it?
It shouldn't if you're only looking at crude, but this exposes a fundamental misunderstanding of how the energy market actually functions.
How so?
Well, when a logistics company fuels its fleet of trucks, or a plastics manufacturer orders feedstocks, they aren't buying raw, unrefined crude oil. They're buying refined products. Diesel, jet fuel, naphtha, gasoline.
Oh, okay.
And the critical data point right now is the immense widening gap between the price of raw crude and the price of those finished refined products.
Let's look at that data, because the disparity is staggering. Retail refined products, the fuel you and I buy, are sitting at $228 per barrel.
Yeah, which break down to about $5.40 a gallon at the pump.
Right, and that's a 26% jump year over year. But wholesale refined products, the fuels that businesses run on, those are at $134 a barrel, up 71% year over year. The raw crude is only up marginally, but the refined products are skyrocketing.
Because the refineries are capturing a historic premium, You could think of a refinery as a toll booth between the raw material and the end user.
And right now, that toll booth is the actual bottleneck.
Precisely. The crude oil headline numbers look tame, but the margin those refineries are charging to process that crude is acting as an immense hidden tax on the global economy.
And Goldman uses a specific formula to track demand destruction based on these price hikes.
Right, they do. Historically, if Brent crude is hovering around $100 and the market experiences a $10 increase in the price of refined products, that typically cuts global oil demand by about 0.6 million barrels per day.
People carpool, companies optimize shipping routes, the system absorbs the blow.
Right. But the report shows that historical formula is breaking down right now. Because refinery margins are so uniquely high, that exact same $10 increase is hitting a consumer base that has zero padding left.
Wow. So instead of destroying 0.6 million barrels of demand,
It's currently destroying 0.9 million barrels of demand per day. The rate of demand destruction is supercharged.
it's like if a business is carrying a manageable load of debt, a slight interest rate hike is annoying, but if they're leveraged to the brink, that same hike bankrupts them.
Exactly. The global consumer is in that second category regarding fuel costs.
Which perfectly explains why the crude price isn't skyrocketing. Refineries charge so much for the finished product that end users can't afford it. So end users stop buying, which means refineries don't need to buy as much raw crude.
And that lack of demand at the refinery level acts as a massive anchor on the price of crude itself, totally offsetting the Strait of Hormuz supply shock.
So who is actually making these cuts? A modern economy can't just stop functioning. We can't power down hospitals or stop food delivery trucks.
It's economic triage. The report looks at this through the concept of elasticity, how sensitive a specific sector is to price changes. Highly elastic products see demand drop sharply the moment prices rise.
And the clearest example they give is naphtha, right?
Yeah, naphtha. It's a crucial liquid hydrocarbon used as a feedstock for the petrochemical industry. Basically, it's the foundational ingredient for plastics.
And the data shows an 11.2% downward demand revision for naphtha just in the month of April. Jet fuel also took a huge hit, but diesel, which powers agriculture and road freight, hasn't seen anywhere near that drop.
Because the elasticity is different. A commercial farm can't delay harvesting wheat just because diesel is expensive. The crop will rot. They have to pay the premium.
But a factory making plastic toys, if naphtha becomes too expensive, they just halt the assembly line. They stop ordering.
Exactly. The global economy is actively performing triage. It cuts off circulation to discretionary limbs like plastics and air travel to keep vital organs like food production functioning.
It's fascinating. And this triage isn't just divided by industry. The report highlights a massive geographical divide, too. Emerging markets are getting hit much harder than the West.
Oh, absolutely. We're seeing gas oil and jet fuel prices absolutely skyrocket in places like West Africa and India, way outpacing increases in New York Harbor.
Why is that? Why is fuel jumping so much higher in West Africa?
Sovereign purchasing power. Refined fuel is traded globally. When margins spike, wealthy Western nations and corporations have the capital to absorb the premium. They outbid developing nations.
So the physical supply of diesel that would normally go to a port in West Africa gets rerouted to a buyer in Europe who's willing to pay that massive premium.
Which leads to localized scarcity in those emerging markets.
Yeah.
Supply drops, local prices spike even higher, and it forces a brutal wave of demand destruction. Businesses literally can't secure the fuel to operate.
Now, if I'm a politician in one of those emerging markets and my citizens are getting priced out of basic gas oil, my first instinct is to freeze the price. I'd want to cap the retail price at the pump to stop the bleeding.
Which is a natural instinct. But the Goldman report outlines how this political intervention actually creates a massive downside risk for oil demand.
It seems counterintuitive. Walk me through the mechanics of those price caps.
It's a textbook study in unintended consequences. Imagine a government declares gasoline cannot be sold for more than $3 a gallon just to protect the consumer.
On paper, the driver is thrilled.
Until they pull up to the gas station and the pumps are completely dry. Because if a government caps the retail price but doesn't subsidize the refineries are operating at a massive loss. And a refinery simply won't process and sell oil if it loses money on every drop.
They just stop producing or export it somewhere else.
Exactly. The domestic supply vanishes overnight, leading to physical shortages and rationing. The report gives examples of how different powers handle this. China enforces a retail ceiling, but forces their state-owned enterprises to absorb the loss. The government's balance sheet takes the hit.
And India cuts central government excise duties taxes on the fuel, so the refinery gets paid a market rate, but the consumer feels less pain.
Right. And Japan actually subsidizes domestic refiners directly with cash to maintain a strict retail cap.
But the core risk here is that these interventions are incredibly expensive. If a smaller developing country tries to cap prices but can't pay off the refineries, the supply chain breaks. The gas stations run dry.
And a dry pump is the ultimate form of demand destruction. Zero gas equals zero demand. That vicious cycle further suppresses the global price of crude.
It really perfectly illustrates Goldman's two-sided risk. The blockade pushes prices up, but refinery margins and government rationing pull them right back down.
Yep.
But before we wrap up, I want to touch on one last key data point from the supply side. Let's look at crude production shut-ins in the Persian Gulf.
Right. A shut-in is when a producer intentionally stops pumping from an active well because they have nowhere to put the oil. In mid-March, Goldman expected the blockade to force regional producers to shut in roughly 9.7 million barrels per day.
But the actual estimate came in much lower at 8.0 million barrels per day. So there's 1.7 million barrels of crude being pumped every day that Goldman expected to be shut down. Where is it going if it can't leave the Gulf?
Into storage. And the scale of that storage is altering market psychology. The Middle East has way more on-land and floating storage capacity than modeled. They are physically diverting crude into massive tank farms and stationary supertankers.
They're just stockpiling it behind the blockade.
Exactly. And that stockpile acts as a massive psychological dampener on the futures market. Speculators know this oil is already extracted. The second the blockade lifts, there's an ocean of ready-to-ship crude waiting to flood the market.
It's like a loaded spring. Traders won't bid the price up to $150 a barrel if they know millions of barrels could hit the market tomorrow and crash the price.
Precisely. The unprecedented demand destruction from refinery margins, plus these massive physical storage buffers, are the mechanisms keeping that spring from snapping back.
Wow, it completely validates the unchanged price forecast. So bringing this deep dive full circle, we started by asking why the oil market wasn't panicking despite a 92% drop in flow through the Strait of Hormuz.
And what we found is a global economy locked in an invisible tug-of-war.
Right. The blockade is exerting immense upward pressure on supply, but it's being neutralized by the hidden cost of massive refinery margins. We're seeing economic triage, localized scarcity in emerging markets, and the threat of empty pumps from price caps. Add in the millions of barrels quietly stockpiled in the Middle East, and you get Goldman's exact unchanged forecast.
It really forces you to look past the price of a raw barrel of crude.
It really does, and I want to leave you with a final thought to mull over. For decades, we've been trained to look at the price of crude oil as the ultimate economic ticker tape. But based on what we unpacked today, maybe we've been staring at the wrong ticker.
Yeah, maybe.
If refinery margins are the actual force dictating whether a plant in India stays open or an airline grounds its fleet, maybe the obscure wholesale price of naphtha is the real crystal ball for the global economy.
That's a great point.
Thank you so much for joining us on this deep dive. If you enjoyed this analysis, please subscribe to the channel. Our next deep dive is going to be even more exciting. And as always, a quick reminder that this video is for research and analysis purposes only and does not constitute any investment advice. Keep questioning the headlines, and we will see you next time.